Hello there, in Lecture Series 6, I will focus on the underlying principles of IAS 20, Accounting for Government Grants and Disclosure of Government Assistance. IAS 20 deals with two areas, that is government grants and other forms of government assistance. Government grants or government assistance in the form of transfer of resources to an entity in return for past or future compliance with certain conditions. So, when should a government grant be recognized? IAS 20 stipulates the government grant should only be recognized when the condition for receipt have been complied with and there's reasonable assurance that the grant will be received. The recognition and presentation of government grant will depend whether the grant is an income-based grant or related to assets. In the case of an income-based grant, it should be matched with the expenditure towards which they are intended to contribute and presented in the profit or loss either as a separate credit or netted off against the related expense. Grants related to assets should be recognized over the expected useful life of the asset. IAS 20 permits a choice of either deducting the grant from the cost of the asset and depreciating the net cost, or the grant is treated as a deferred income and released to the profit or loss over the life of the asset. In the event a government grant becomes repayable, this may arise if an entity fails to comply with conditions set out by the grant. In such a case, the amount repayable should be accounted as a change in accounting estimate in accordance with IAS 8, Accounting Policies, Changes in Accounting Estimates, and Errors. If the grant is related to assets and the entity has adopted the deferred income approach, any amount repayable is first debited to deferred income to de-recognize the liability with any excess charged to the profit or loss immediately. However, if the entity had adopted the net cost approach, the repayment should be debited to the related asset. This will increase the cost of the related asset, thus increasing the amount of depreciation that should have been charged. This increase should be recognized and charged immediately in the profit or loss as a change in accounting estimate. In the case of income grants where receipt is being recognized over several accounting periods to match with the related expenditure, the entry to recognize the repayment will be the same as capital grant where the deferred income approach is adopted. A government grant may take the form of a transfer of a non-monetary resource, example land. In these circumstances, the normal accounting treatment is to assess the fair value of the non-monetary resource transferred and account for both the grant and the asset at that fair value. IAS 20 does allow as an alternative to record both the asset and the grant at nominal amount. The following are excluded from being recognized as government grants. Firstly, government assistance which cannot reasonably have a value placed upon them. Examples may include technical or market advice provided by the government to an entity. The other are transactions with government which cannot be distinguished from normal trading transactions of an entity. An example is a government procurement policy that is responsible for a portion of the entity's sales. These government assistance are not recognized in the financial statements. However, if these government assistance do provide significant economic benefits to an entity, IAS 20 requires the entity to disclose the nature, extent, and duration of the assistance to ensure the financial statements are not misleading. This concludes Lecture Series 6. In my next lecture series, I will look at IAS 38, Intangible Assets. See you in my next lecture series. Thank you and have a pleasant day.